Well, hello. How's it going today? Hey, this is Ed Parcaut, your host of Real Estate Jerky, the radio show. And this is the Real Estate Jerky Live, the extension of the radio show, where we go more in depth with guests and other topics that come up on the radio that we can't really talk about when we're on the radio because if you know anything about radio, it's a short amount of time that you have with all the commercial breaks and everything. So most of the guests we have on have about 18 minutes to explain everything they're talking about. And that's not a long time. So that's why we started this whole idea of Real Estate Jerky Live to go more in depth. Today, what we're doing is we're going to be talking about refinancing, which is a subject that's been huge over the last year. But lately I've been asked, is it still a good time to refinance? And there have been some other questions. So we'll get into all that through today. And first, let's get right into the topics so you don't have to wait. So the question I had was, or I'm asked, what are the good reasons to refinance your mortgage? Well, for most people, they look at the number one benefit, which is lowering your monthly payment. And for a lot of people, that's a great idea. But there's also more things that you can do than just lower your monthly payment. You can pay your loan off. See, I'm going to jump out of order right here. But basically, you can use the equity in your home that you've built over the last so many years, because especially here in California, we've seen a massive increase in equity. Most places have been increasing 10 to 15% in value over the last few years. And so you have a lot of money left in your house that you can use to help pay off and manage debt better. You can, instead of just lowering your payment, you can lower your term. And I'll get more into that a little bit later. But basically, that would be taking a 30-year that you have now, so you have 27 years left on it, and you go to a 20-year loan. And that's just a benefit for a lot of people. The other thing is you get a low rate for the life of the loan. These are the benefits and the reasons why you should do this. All right. So the other thing someone was asking me the other day is basically, is that the only reason you do a refinance? And no, there's many reasons, but let's get into lowering your payment first. So a lot of people are looking at their current situation where they got a home loan. Their current interest rate is 4.5% or 4%. And the current market, if you talk to Fannie and Freddie out there, you're looking at about 3%, right around there. Today's rates keep getting a little bit better each day because of things that's going on. So basically, you could actually lower your payment a few $100s, and that makes sense for a lot of people. But the other reason you want to do it is, say you have an FHA loan or you have a conventional loan where you have mortgage insurance, and you can actually get rid of your mortgage insurance by doing this. And that's what a lot of people will look at. I paid 3% for my house. I did 3.5% FHA. Let me look at to see if I can get rid of the mortgage insurance, which is anywhere from, could be when they got the loan around 150 to 175 bucks. Larger loan amounts will have higher amount. But what I like doing a lot is reducing the term of people's mortgages. So this last year, we've done a lot of refinances where people could save $500 a month. But what they did is they took their term from, as I said earlier, from like 27 years to 20 years, and their payment was the same. Or they even went down to a 15-year where their payment went up by a couple $100. But if you're taking 12 years off your mortgage, that's a very long time to save. And the hundreds of $1,000s in interest that you save is such a huge benefit to that. Now, a lot of times people look at the benefit of going from an adjustable to a fixed rate. I haven't seen a lot of adjustables in the last few years because fixed rates have been so low. So most people have not got the adjustables. But if you're still in an adjustable, because there was some 7-year ARMs, 10-year ARMs, where you were fixed for 5, 7, or 10 years, and then you went into adjustable, that it would be the time to look at refinancing that and to put it to a fixed rate. But what I'm also seeing a lot of people do is they come to me and they've had taken out a home equity line of credit. And they're saying, how do I get rid of my home equity line of credit? Because that's just, most people don't understand what a home equity line of credit is. Basically, it's a second mortgage that's attached to your house that is an adjustable rate. And most people didn't realize that. And that's tied to the Fed fund rate. So while our rates have been going down, we've actually benefited, for most people, for those loans that their payment hasn't went up. But the first 10 years of the HELOCs, the home equity line of credit, is all interest only. Then the final 20 years is the full index rate and term, and people's payments go from a couple $100 to, on average, $800. So for me in this market, I get asked a lot of times, should I get a HELOC? I want to get a HELOC to pay off my debt. I think a better answer would be to do a cash out refinance. And so that's what I want to get into now. How to use the equity of your home to take out cash and pay off debt. I'm not talking about going to get a jet ski or going out and getting, some different things. But if that's because right now is a perfect time to do this. And I have a little example over here, and let me see if I can share it to the screen. Yep. Thank you. All right. So I want to thank MBS Highway for using their little thing here. All right. So what I'm looking at is you bought your house. You have $257,000 is what the original price was. You went through the whole thing. Your current, let's go with your current payment of the house. So you're at 4.7% interest rate. Your current payment is $1,815. Sorry if you can't see that very well. And then, so that is your current house right now. And you look at, okay, well, I have some credit cards, and I just threw some numbers in here. This number is a little high, so let's adjust that down. Update debt. All right, let's go back up. All right. So that's a little bit more in line. So these are, and this is not a big, so this is about $33,000 in credit card debt. And then they have a car loan, right? And so that costs them about $1,852 a month, including the car payment, because that's what they have left on the debt is $35,000. Average car payments these days are around $800 if you're buying a $40,000, $50,000 car. So what we're looking at is, what do we do if we pay off the debt? Is that going to make a benefit to us? And so what I did is, if we go down here and if I say, okay, we're going to pay off these 4 items, right? And let's see, I selected those. So that's going to save us about $1,400 a month, $1,418. And that's, so we'll have, so if we look here, our proposed existing value is about $525,000, could be a little bit less. This still will work on those numbers. We have equity in our home. Closing costs, I just estimated closing costs in here, and this is just the closing costs that you would pay, not prepaids or anything like that, just regular closing costs. On a 30-year conventional loan, I did it at 3.5, which is you can get much better today, but I just wanted to show it's an example, not exact numbers. We're going to include 35. There's a debt balance still that's not included, and that's the car loan, and we're going to include $33,500. All right, so if we do that and we go down here, we pay off that debt, that means we save $1,418 a month. And a lot of people say, okay, well, I've just taken short-term debt and turned it into long-term debt. And a lot of people say that is correct, but I'm going to get rid of this little statement there. There we go. So if we go down here and we look, so if we take that same money that we just saved by paying off these 4 items and we reapply it to our 30-year loan, right? So we apply it towards our current principal of the new loan. That means our new term for that new 30-year loan is going to be 11 years, 2 months. That's right. So what you did is you took that same money that you're putting on credit cards every month, and now you applied it, you paid them off, and now you're applying that number back to your mortgage, and you can pay it off in 11 years, 2 months, and you'll increase your net worth by $144,000. So for most people, they're like going, this is a great idea. And it is a great idea because you've just benefited from doing that. The other thing is, if say that you decided to include the car loan in there. So let's include the car loan. Now you're saving $2,100 a month. And if you apply that same dollar, you can pay the loan off in 9 years, 4 months. But, a lot of people say, well, I'm not going to do that because I need a new car down the road. And I understand that. So we'll just take that out. And here's the example. And for me, I was totally against the idea for a very long time of taking short-term debt and turning it into long-term debt. But for this scenario, it works really well. And I'm going to get out of here. All right. So as you can tell, cash out refinances, a lot of questions are they, so what, I think I have a question over here. Let's see here. All right. We have a question. Let me ask, can I refinance at any time in life or the year, or does it have to be at certain times of the year? You can refinance any time that makes sense to you and it makes sense to what's going on. The only time you run into issues where you have to wait to refinance is, say, if you purchased a when you're with a VA loan or a FHA loan, they have time periods that you have to wait before you can refinance that loan to a VA or to another FHA. So that's what you run into with time frames. Let's go down here. I have another one. So I had a question. Does cash out refinances, does cash out refinances increase mortgage payments? Well, they can, if you're just taking cash out and not doing anything. So basically, if we took everything out of here and we just did a cash out refinance and took the same amount of money, your payment would go up by a few $100s a month because your interest rate was going down. So it's going to offset. Everybody's situation is going to be different, and you need to have the numbers run. You need to don't think about this for yourself. Find somebody to help you to go through the numbers and see if this makes sense to you to do refinances. Let's see, I have another one. Our cash out refinance is a good idea. Yes, it depends on the situation and what you're doing. But for most people, if you run the numbers and you're paying off debt and then you reapply that principal back, that dollar amount back to the principal, you can pay your house off even faster. And a lot of people don't realize that. And in that, as I said earlier, I was against these ideas until I ran this scenario, and I was like, wow, I'm doing a disservice to my clients by not offering this to everybody. And so that's what we're doing now, is we're going through everybody's situation and saying, hey, you might want to look at this situation. Rates are, still historically low compared to where we used to be. We're right about an eighth lower than we were prior, a year at this time last year. So that's still a great time. Let's see here. I thought I had another one. Let's go back down here. Make sure I cover everything. I think I already went over this. This was one that was text to me. Which is better, a cash out refinance or a HELOC? For me, I think a cash out refinance, if you're going to take the money out now and you're going to use it for right now. A HELOC is a great idea to have there just in case something happens in life down the road. And then you can actually pull, if you didn't understand, the HELOC is a home equity line of credit. It is adjustable, as I stated before, and it is based off the prime rate, and it's either prime rate plus or minus, depending on where you get them. We do them here too, but it's still, I would rather you do, if you need the money right now and you know how much it's going to be, let's take it out in a fixed rate and have it fixed for the remainder of the time you need, to make sure you make the right payments. One more question I see here that was texting me earlier. How does a cash out refinance affect taxes? Well, I'm not a tax advisor, but what I would tell you to do is talk to your accountant, talk to your tax advisor. But for most people, because of the way our tax laws are right now, most people take the itemized deduction of $12,500 per individual. They're not actually writing off the interest. So that for most people, it probably will not affect them. But what I would tell you to do is talk to your tax advisor. All right, let's go through some other stuff. Benefits of a home refinance. See if I missed anything. This is, what are the risks of loan refinancing? So this wasn't a question. This is one I put in there. The risk of loan refinancing. If you refinance, so a lot of people in the past, because a lot of people saw their parents back in 2006 or 2005, and they had taken money out. Now their house became over encumbered, meaning that it was worth less than what they owed on it. And then a lot of people lost their homes during that period of time. The difference right now is we've had a lot of creation of equity moving forward, and that we have such a tight market for homes and the depreciation that we're going to see over the time, that for most people, there's not going to be a risk if they do it right. If you use it as an ATM and just keep refinancing, taking cash out to pay for certain things and pay for other things, and you're not making your debt work for you, it could really put you in a bad situation. So please, before you do anything, get some advice. Talk to your financial planner, talk to a really good mortgage advisor. And if you have any questions, you can always direct message me through here. And I think that's all we have for today. Let's see here. Yeah, we already went through that. All right. So that was just a quick little thing about refinancing your home and whether you should do it. I'm not going to get into the different programs, whether it's VA, FHA, conventional, that kind of stuff. Because each one of those, to explain those, when we do those for clients and for real estate agents and offices, those are all an hour program each, and that would just be too much for you today. So I hope this kind of big thing went over was cash out refinances. Are they a good idea? Yes, if used properly. And if you go through the scenario that I showed you, that would be a good scenario to do, and then reapply it to mortgage. I actually had somebody that we did a refinance for, and they went from a 25-year, and they didn't do a cash out. They just did a rate and term, 25-year. They went down to a 15-year, and then they applied additional $700 a month on that 15-year loan, because that was the same payment they were making before, and they actually were going to pay that home off in 9 years. So could you imagine yourself, if you do a cash out refinance, get your debt reappropriated properly, and was able to pay your house off in 10 years or 11 years by applying the money that you're putting towards debt right now towards your payment? The other thing I want to talk about, one last thing I just remembered, so I have to go back over to the share, so bear with me. And what I didn't talk about, and this is, again, I want to thank MBS Highway for letting me use their stuff today. One of the things we were talking about, so when we look at our credit card debt, this is $33,500 in debt. The average credit card interest rate is about 20%. So if we do the rule of 72, which means that the rule of 72 is that whatever your interest rate is, you divide it by, and that's how many years it will double. So what I did is I put in here, let's put 20% in here. So this is why credit cards love people borrowing on them. If you do nothing at all, your debt can double in 3 years, right? Your credit card debt, if you make the minimum payments to barely make anything, you can actually have your debt double on you, not get paid off in 3 years. If you add on your minimum payments, just to say we put it, it's say $450 is what you get towards your, most of it's interest, but say you put $450 towards principal, and you calculate, still in 3 years, you still owe more than what you owe today. So wouldn't it make sense to pay this stuff off and benefit you? I think it does. So let me get out of here, and I hope I answered everybody's questions. Let me double check. Yep. All right. I want to thank you. This is Ed Parcaut with Real Estate Jerky Live. We're here Tuesdays and Thursdays at 11 a.m. Normally we're interviewing somebody, but I kind of wanted to get this out there because I've been asked multiple times about this. So thank you so much. And you guys have a great day.